All right, welcome to the weekly prep video for the week of July 6th to the 10th. In today's video, I'll be going over the action from the past week of the indexes, the liquid leaders, industry ETFs, then another video with long and short setups going into next week, like I do with every weekly prep video. So if you guys enjoy it, please leave a like and subscribe to the channel. And if you want my market takes throughout the trading day, along with the live stream at the open and any trades I personally take, you can sign up for the Market Pulse Discord using the link in the comment section. Before we get started, just hope everyone had a great 4th of July weekend, that they were safe with the fireworks. We're coming back to the desk on Monday with all 10 of our fingers to trade with. And yeah, hopefully everyone could use the long weekend to recharge. But we have to come back on Monday sharp. So let's prepare for that. Monday open, NASDAQ last week up 0.86%. Very strong action on Monday and Tuesday, but then we got that gap down Wednesday and week close. And then on Thursday, we really did see a lot of distribution, especially from semiconductors, memory names, tech names. So while the indexes don't look that bad, a lot of the growth stocks got hit, which we'll cover in the leaders and the ETF lists. But NASDAQ just comes right back to that 50-day moving average, really consolidating well over the past couple weeks. Basically, since the pattern day trade rule got lifted, the market topped, and we've just been a choppy mess since then. But a choppy mess after a 34% rally in 2 months of just straight up action, staying over the 5-day EMA that entire time. Like, this is to be expected. So while it's not super comfortable to trade in, like, while we're in it, this is what should happen after a big move up like this. S&P 500, extremely strong last week, up 2.2%, closing back over the 5, the 10, the 20, and the 50-day moving averages. Because exposure in the S&P 500 is not as tech heavy, not as semiconductor heavy, we saw money rotate on Thursday and almost closed the day up, only down 0.13%. IWO, the growth stocks of the Russell 2000, down 0.4% on the week, closing under the 5 and the 10-day EMAs. Just kind of going sideways over the last couple of weeks, volatility picking up, but nothing really breaking down here just yet. ARKK, which is heavy in the genomics theme, even though they have their own genomics ETF, ARKG, which I would check out. Really good strength all last week because that individual group was very strong. Back through the 5, the 10, the 20, and the 50-day moving averages. Closed only down 0.7% on Thursday and still up 4% for the week. And then the MAGS ETF, just the Magnificent 7, tracking the mega cap stocks. Awesome week last week, up 5.7%, and only a tiny bit of a give back on Thursday with an inside day back to that 200-day moving average. So we could switch over and take a look at Bitcoin, which is trading over the weekend, obviously. And that has gotten back through the 5, the 10, and the 20-day EMAs, trading right around 62.6. Bitcoin has been relatively weak. That's a fact. That's not up to debate. But you would expect like that relative weakness to really start to accelerate to the downside as the market gets weaker. And every time we undercut the lows, we just kind of bounce back. We undercut the lows and then we bounce back. So there is some very nice relative strength recently in Bitcoin, maybe money rotating from the semiconductor stocks, from the memory trade into more of the speculative like crypto or software and the rest of the market. So we'll see if this continues or if this is just kind of like a bounce over the weekend, but back through the 20-day EMA. So it is a start. Ethereum, kind of the same thing, almost back to the 50-day moving average. Some nice relative strength in Ethereum compared to Bitcoin recently. And I also wanted to take a look at the dollar index, which we were concerned if this is breaking out of a multi-month base, then that would put pressure on equities. But for now, at least, we rally back up. It looked like we were breaking out, rejected off this just tiny resistance gap. I don't even know if those work for the dollar, but funny enough that we did reject right at that spot. And for now, we're just coming right back into that breakout retest, that 20-day EMA. So if this could be a false breakout and then we break down on the dollar, equities can fly, especially if we consolidate for another 2 to 3 weeks on the NASDAQ. I think that would be awesome. But if this is a higher low and then we rally and truly break out of this base for the dollar, that will kind of put some pressure on equities. Taking a look at the leaders list, I have 10 on here now. After Monday's trading, I'll take one of them off, but wanted to to kind of update this. I added CrowdStrike, PanW, and GEV. CrowdStrike up 10.6% last week. Awesome action. I do own this stock. Got into a new all-time high on Thursday and then closed slightly below that resistance gap. I know Ariel will call this a double top short sale, but I think it's a strong stock and a leading theme. So we'll see how that goes. But up 0.4% on Thursday and 10.6% for the week. PanW, another cybersecurity name, incredible strength. I would say definitely stronger than CrowdStrike because it already made new highs. Up 14.4% last week, inside candle on Thursday. Plenty of air to the 5-day EMA, not doing anything wrong there. Then GEV, every time I think this stock is done and I should take it off my universe list, which it really did look like it this time, we get 1, 2, 3, 4, 5, 6 gap ups in about 10 trading days, right back into a new closing high on Tuesday, and then just a pullback into the 10-day EMA on Thursday, up 6.5% for the week. A-Lab up 3.8% for the week. And for a semiconductor, that's incredibly impressive because a lot of them did get rocked on Wednesday and Thursday. And I mean, on Wednesday, this was down 10.8%. Thursday, this was down 5.6%. So it absolutely did get rocked on those 2 days. But the strength on Monday and Tuesday made up for that. So pull back to the 20-day EMA. Can this find its footing and then continue to build out? Or are we seeing volatility pick up and eventually that breaks to the downside? CRDO, another one, up 1.6% this week, but volatility picking up. We failed at that resistance gap, closed under the 5, the 10, and the 20-day EMAs. So definitely some pressure on the leaders. DELL down 1.3% this week. Overall, I don't think it's doing anything too wrong. Just a slight close under the 20-day EMA. On lower than average volume too, so I don't think that's horrible. The only nitpick I have with this chart is I'd like stocks to stay above their earnings close if they're going to be aggressively accumulated by institutions, and that does not seem to be the case. We've spent a couple days above, but not too many. But the relative strength here, is notable. This isn't crazy volatile like we've seen in other charts, and it's not just a clean waterfall down like we've also seen. So I want to keep DELL on the radar. Intel, I got stopped out of this on Thursday, down 6.2% for the week, 5% on Friday, closed under the 20-day EMA. We do have a support gap down here, so that's going to be a spot that we'll watch. GLW, new to the list last week. Great Monday, great Tuesday, and then fell apart on Wednesday and Thursday, down 13.6%, then 10.8%, down 11% for the week. And then the memory trade, which that really unraveled this week. MU down 13.8%. And this is a stock that gapped up on earnings and then gave that kind of back over the last couple of days with 2 unfilled gaps to the downside. I'm sure a lot of people are going to see this on Monday and then come in and be like, okay, the memory trade's over. I'm going to short it down here. And the thing with these, when leading stocks don't have true blow off tops and it's just volatility picking up, once everyone thinks the trade is over, that's when you get a snapback rally. So any weakness on Monday or even on Tuesday, I would be careful shorting into that weakness after a pretty steep pullback, 24% off the highs here. And then SanDisk down 16.5%, closed under the 20-day EMA on a big pickup in volume. We saw volatility increase. We saw unfilled gaps to the downside. Trends do not change until you get a gap in the opposite direction, and we got that on SanDisk on the 26th there. Then we rally back up into that resistance gap and fail again on Wednesday with that gap down. So volatility definitely increasing here, but again, if you're gonna short these memory stocks because they were extended, down here or even more weakness into the 50-day moving average, I don't think that's the spot you want to get aggressive. Then into the industry ETFs, because it's the weekly prep video, we'll go through every single one and just spend more time on the more important ones. And we'll sort this by price percent change for the week. UFO, that group has been getting decimated. It makes sense that eventually there's a relief bounce. We got it at a support gap, got back through the 5-day EMA on Monday with that gap up, and then some nice relative strength on Thursday, only actually up 0.1 or up 1%. Still needs to get through the 20-day EMA. We have the 50-day that's declining, but at least we get a relief bounce. Maybe we could build out some higher lows and then kind of go from there. Cybersecurity, incredibly strong, up 6.2% for this week, only down 0.5% on Thursday. We do have this resistance gap here, so we'll see if we can get through that. That's also a resistance gap on CrowdStrike as well. So, because I'm long CrowdStrike, obviously I hope that that just rallies through and we can get into new all-time highs. IGV, software ETF, awesome rotation this week when everyone said, oh, software is actually dead. That's when you get this big candle last Friday, the past Friday, and then gap up on Monday, a little gap down on Tuesday that rallies back up, and then great strength on Wednesday and Thursday. ITA, aerospace and defense, up 4.8% on the week. We get up to that previous high, that resistance gap, and reject there a little bit on Thursday. But overall, this is a nice base. Multiple higher lows on the 200-day, then a higher low on the 50, then a higher low on the 20. And now we're seeing a nice rally there. MSOS, the cannabis ETF, we have this big base. Things are consolidated. I don't really trade this very often, but just have it on the watch list because I do have like this very large base there. BOTZ, the robotics and AI ETF, heavily correlated with NVIDIA, just lots of weakness. On Thursday, down 1.8%, back into the 5 and the 10-day EMA, under the 20-day, but we did get a relief bounce with NVIDIA earlier on in the week. XLF, the financial ETF, very, very strong, up 3.8%. And this is what I mean by money is rotating in the market and not just leaving altogether. Super extended semiconductors, super extended memory names, like a little bit of that money can go a long way in some of these other groups, and financials and other rate sensitive like groups looks like rates are coming down. So even though inflation is higher, even though we got the new FOMC or the Fed chair, and he sounded pretty aggressive about cutting down inflation, doesn't seem to, the market is kind of calling his bluff on that one. But financials look great. A lot of stocks making new highs in that group. And XLF itself, stone's throw away from new all-time highs. ARKK, the genomics ETF, just incredible strength. Kind of what I mentioned with ARKK earlier. We got this big base, like multi-month base that we're breaking out of. And there's a lot of individual stocks, which I don't love to trade individual like biotech or healthcare stocks, but some of them, they work very, very well. But if you just want exposure to the group, ARKK is a nice way to do that. It's obviously a little extended here. I'm not trying to chase the price up here, but on a pullback maybe to the 10-day EMA after some consolidation, something to watch for. FDN, Dow Jones Internet, nice gap up through the 200-day, closed under the 50, just a lot of chop there, but up 3.3% on the week. XBI, the biotech ETF, just pure accumulation. Look at the dollar volume coming in on this ETF and the clean rise over the 5-day EMA. This is definitely a leading theme in the market right now. Not going away. Just 2 days of low volume pullback and then just more strength on Thursday while the rest of the market was getting hammered. Really, really nice to see there. XLY, consumer discretionary ETF, back through the 50 and the 200-day moving average on Thursday, just chopping out a nice big base. XLV, the healthcare ETF, new all-time highs, obviously a leading theme in the market. GDX, gold miners, super weak under declining 50-day and a 200-day that's just starting to flatten out now. Probably a relief bounce at some point into some of these overhead gaps. Maybe the 50-day catches up there, but not a group I'm really focused on. IYT, transportation, ETF, new all-time highs. Not usually bearish. XLB, basic materials, nice base built out here. This looks like it's ready to break into new highs. XLP, consumer staples, nice base here. Looks like it's ready to rally. PEJ, leisure and entertainment, looks really good for higher. A lot of these are rate sensitive groups, and with oil prices coming down as we get closer and closer to a resolution with Iran, that's going to help inflation come down a little bit, and maybe we can get some rate cuts. XRT, the retail ETF, massive base here. I think this group, again, very rate sensitive, but if this breaks to the upside, there's a lot of pent up energy here. And while people will still kind of chase software or not chase software, chase semiconductors and all that, like there are other groups that are ready to go higher. URA, uranium, this just stays really heavy. TAN, solar ETF, which is typically rate sensitive, not looking great. Maybe because I don't really know why this would be going down. My only theory is like, hey, we're not going to be as like reliant on solar because oil and gas prices are coming down. Don't know if that has any correlation, but just weird to see all the other rate sensitive groups extremely strong while solar stocks like reversed and then just fell apart. IYZ telecommunications just kind of slowly breaking to the downside, down 1% last week. XLE down 1% last week. Still kind of hanging out at these lows where we bounced last time. ITB, home builders, big push through the 200-day moving average last week. So then some chop coming back into the 10-day, I don't think is bad action overall. Up 0.74% on Thursday, but down 2% for the week. XME, metal and mining, stays very heavy. A lot of the precious metals not looking great. Then semiconductors down 3% last week. We saw the gap down, like the hangman candle, gap down, rally back up, and then you close into that resistance gap, but then followed up with a gap down. And we've just seen volatility explode in semiconductors since June 3rd here. So I like just time going sideways, letting the 50-day moving average catch up, let some volatility out. Like we'll probably undercut the 50, bounce, start to tighten up, and then we could get going again. But when volatility is this high after this big of an extension, you either want to shorten your time frame on trades and just trade like buy the undercut, sell the rip, or focus on a different group while this is consolidating. Then last one, WGMI. I really had high hopes for this, thinking about like powering all the data centers, and then Meta comes and says that they're going to be doing that as well, and that just kind of tanked all these Bitcoin miners turned data center powering stocks. Down 19% last week, just completely fell apart on Wednesday, down 6.8%, down another 9.5% on Friday or Thursday, excuse me, and yeah, not a great looking chart here. So if it comes back, it'll need like plenty of weeks to rally up, pull back, build out some higher lows, tighten up. So this will need some time. You could play an oversold bounce, sure, but like for a longer term swing trade, I think it's going to need some time to tighten up. Then taking a look at the Market Pulse theme tracker. Everyone in Market Pulse has access to the site. It's not just a breadth page. We've got COT data, earnings calendars, scanners, all that good stuff. But I like to take a look at the breadth each day. And this is showing us that money is not leaving the market altogether. 264 stocks were up 4% or more on Thursday. Only 293 were down. But it was the 293 stocks that most of us were trading over the past 3 months because it was semiconductors, it was memory stocks, it was those like more typically like growthy tech names that got hit the hardest on Wednesday and Thursday. But it's not like money just left the market altogether. 5-day ratio still at 1.35, meaning like for every one stock that's down 4% on the day, 1.35 stocks were up 4% that day. 10-day ratio still positive at 1.14. Stocks extended 10 times. Their average true range from the 50-day moving average did come down a little bit from 14 to 12, but not at an like overvalued mark that we saw at some prior peaks at 42 or 49. And then stocks over the 50-day moving average actually going up because, again, money is rotating from super extended tech names into the rest of the market. So while like QQQ or SMH, semiconductors are pulling back, the number of stocks over their 50-day moving average, or the percent of stocks over their 50-day moving average, has been going up since June 17th, which is another reason why like our goal as traders is to be in the leading stocks, in the leading themes. That's where like the big money is made. That's why like looking at breadth metrics, it can sometimes like lead you astray to say like, hey, this like the number of stocks over the 50-day is improving. That should be a better market to trade in. And unless you're like looking outside of the leadership stocks, it really isn't. It usually means like volatility is really hitting the leaders, and we're seeing money spread out throughout the rest of the market and kind of de-risking. So it's better than money leaving the market altogether and everything's crashing, but that usually happens like towards the bottom of corrections or bear markets. When you see breadth improving while the leader's breaking down, that's usually like the start of volatility picking up. So keep that in mind. Then taking a look at NAAIM, Active Investors Exposure Index. This comes out as of Wednesday's close. It comes out on Thursdays. And over 95% is my threshold for an overbought market. Doesn't mean the market just crashes right after that, but I've noticed my win rate on new trades once exposure is over 95% tends to go down. The leading stocks usually still have like a final move higher, but once you get over like 95%, it's kind of like who else is left to buy the market. And that's what we saw. We got to 98.6% last week, and then this week was super volatile with the leaders kind of breaking down. But we did get a decrease in exposure back down to 84.7%. Still elevated, but not at that overbought level. I would love to see this over the next couple weeks. Like if the market continues to correct, the NASDAQ like corrects, goes sideways, maybe we lose the 50-day moving average, get some panic in the market or some fear in the market, get this down to the 70s. That would be phenomenal. Even the higher 60s would be great for kind of an end of year rally after this correction. And I know it's not a correction based on percent. At least I don't think it's 10%. No. But just like corrective action, sideways action after a big rally. And then because the market was closed on Thursday, closed on Friday, we didn't get updated COT, commitment of traders, futures positioning. Just to run through what we had last week, though, we finally had on the S&P 500, we had net long exposure finally from speculators. And it's the most long speculators have been the S&P 500 all year long. Now, large specs in the blue are still net short, but small specs are net long. So on a total speculator basis, they're long the S&P 500. Whoops. And then if we go to the NASDAQ, neutral positioning there, nothing really changed. Russell, slightly short positioning, but nothing extreme. And again, this is already delayed. Commitment of traders data is as of Tuesday, and then it gets released on Friday. But because the market was closed on Friday, we'll get new data for this past week on Monday after the close. All right. Last thing, we are starting the beginning of earnings season. Not too many important stocks, but what is it? Tuesday after the close, PENG, which has been a leader in the semiconductor and memory group, that is reporting. So I'll keep an eye on that. And then a lot of the travel stocks and airline stocks have been very strong. Delta's reporting before the market opens on Friday, but nothing major next week. Just start to prepare for earnings season, which is coming around the corner. And with that said, let's go into the long and the short setups. On the long side, on both sides, we'll sort by average dollar volume. So it's most liquid to least liquid. And again, a lot of these, like because volatility is picking up in the market and picking up on the leaders, there's two different ways you could trade this. You could look at different like other groups to trade that aren't your like typical growth stocks that you want to trade, or you can shorten up your time frame and just play some oversold bounces. Whatever works best for you. I kind of sprinkled in a couple different things, but still focused on like oversold bounces in the leaders because they're going to be more volatile. That's going to give you some like nice risk reward spots. So a lot of these we're looking for one more push down on Monday or maybe Tuesday into rising moving averages, support gap zones, spots that we can risk against. So with SanDisk, we obviously big pullback on Thursday, down 14%. If we could get another kind of washout sale into the 50-day moving average, into the support gap here at 1590, that's a spot that I'd look for an oversold bounce. And I'd size that up pretty aggressively because we have a key spot, a support gap low for an undercut and reclaim to get long. Intel, like I mentioned earlier, the support gap under the 20-day EMA, little undercut and reclaim there would be the buy spot, and then your stop is at the 50-day. AMAT, looking for an undercut of the support gap under the 20-day moving average at 570. So undercut. And then it's not just buying into the weakness, it's the reclaim of that support gap low, which is my entry. And then the stop is just going to be the low of the day. NBIS, we're already back to the 50. This was taken off the leaders list this past week, but usually your first test of the 50-day moving average is a good risk reward spot. We're also right at the high volume close from earnings through there. So just taking out Thursday's low, reclaim Thursday's low, and that HBC right at 208 or so. That would be the buy spot, and then your stop is the low of the day. ARM, we have the 50-day and the support gap basically right at that $300 level. So undercut 300, reclaim that support gap low. That would be the spot, and then your stop is under the 50-day. DELL from the leaders list, I still think is acting incredible. Would love to get a gap down under the low on Thursday, then an oops reversal where you gap below the low, rally back above that low, and that is your entry when you recapture that low of the previous day. Then your stop is the low of the current day. A-Lab, we have a support gap under the 20-day EMA at 375. That's the spot that I'd look for the bounce. And then ANET, this one is actually shaping up relatively well. It didn't go on the monster run that a lot of these stocks went on, but it is, I've never traded ANET well, so let me just put that out there. But it is a stock that, like, when it does get going, it has like these 3-week bursts that is very linear, but then it chops like crazy. So we're in that chop phase. I want to use that volatility in my favor for an entry. I don't want to be chasing this higher and then have that volatility come back on me and stop me out. We almost got to the low of the support gap on Thursday, an undercut and reclaim of that spot, 156.50. That would be the buy spot with the stop under the low from June 26th. Couple software names next. FTNT, new highs on Thursday or on Wednesday, and then inside candle on Thursday. We look for this to pull back into the support gap, just kind of a breakout retest area at this 150-130 spot. Net, nice big base here. Tried to get going like earlier in June and just kind of fell apart back down to the 50-day when software stocks sold off. I'd say this is like still a little bit weaker than some other names, but we could pull back to the 20-day EMA and then kind of rally back through Monday's low. That would be viable. But this is more of a setup that I'm looking in the back half of the week as like let it pull back, build out a higher low, and then we like have an even better base to work with. Last week, a lot of stocks that have been living under their 200-day moving average, but were strong growth stocks in the past, got back through the 200-day. I bought Robinhood, should have bought Reddit on Wednesday. Great action here, up 13.9%. And then great action on Thursday. We pull back into the 200, bounce exactly at that spot, and then close well in the daily range. Even though it was down 1.6%, great relative strength compared to the NASDAQ and the rest of the market. So this just want to like another pullback into the 200-day, a breakout retest of this 150 or 185 spot. And then because we're just dealing with a moving average, I always like to wait for a reclaim of the daily VWAP to put that risk on. So momentum is on your side as you're putting on the risk. If I'm buying an undercut and reclaim of a support gap, I'm not waiting for a VWAP reclaim because I have a very key level to work against. Moving averages, I view more as just kind of guidelines for a stock. And that's why I wait for a VWAP in those situations. AXSM, a pharmaceutical name. And whenever I trade an individual biotech or pharmaceutical stock, I look to see if they have over $100 million of revenue each of the last 4 quarters. This one does 150, 170, 194, 190. Even then, my position sizing will come down on these names just because there is some of that overnight risk. AXSM, really nice rally from 150 up to 260. We pull back to the 20. We bounce there. We're getting nice and tight here, but some of these biotechs and pharmaceutical names are extended. So it wouldn't surprise me if the group comes under a little bit of pressure to start next week. And that's when we're looking for this gap zone at 235, kind of a previous high retest and a shakeout of these lows while the 50-day moving average catches up. This 235 spot is where I have my alerts. FTAI, kind of a choppy base here. So because it's a choppy name and it's still basing, I don't want to be buying this on strength. I want to buy this on an undercut and reclaim. We have the support gap at 241.96, the low there, undercut and reclaim there. And the nice part about buying it there is it's under the 50-day, so it's off everyone's radar. Then if it works and starts to rally back above the 50, then you get a bunch of new buyers coming back in for a stock that's above the 50-day, and you're already positioned where any volatility up here, you're going to be able to sit through because you bought it so well. The downside with buying support caps is when they do break, they break pretty quickly. So your win rate is going to be lower, but that risk reward for buying pullbacks, I think is unmatched in the market. KLIC, another semiconductor name that huge relative strength in the group, finally broke down a little bit on Thursday, down 9.3%, but it's still above the 20-day EMA, was at highs on the day before, on Wednesday, before that finally kind of got impacted. So an undercut of that support gap at 116.65 is the spot that I'd be looking for. And the last one, kind of like a fun one to add, is BOT. It's a robotics ETF, I believe, and just kind of building out an IPO base, rally up, pull back into the 5 and the 10-day. I know some people in Market Pulse are trading this, so just keeping an eye on this. In a stronger market, like I would be playing this through Thursday's high. I still think you could buy it through Thursday's high, but then you got to keep your stop relatively tight on here. And it's a lower dollar volume name. So in a market that's like very hot, something like this can go pretty bonkers. But if we're going to stay in this choppy market and continue to go sideways, which I'm kind of guessing that we will, given how weak the leaders were on Wednesday and Thursday, then this is something you want to be a little bit more cautious with. Then on the short side, I didn't see many quality short setups because, again, I don't like shorting in the hole after stocks have already fallen. I think that's a really dangerous thing to do, especially in a bull market. But shorting in the hole, I think, is always a little bit tricky. So don't have too many names on here. Couple metal and mining to start. HYMC. Actually, no. Let me start with MSTR. I did take the short on Thursday, trimmed a little bit. I probably am going to get stopped out on Monday because of Bitcoin strength. I guess we'll see what happens the rest of the day. I'm filming this early on Sunday, so we'll see what happens the rest of this day. But we did rally in Bitcoin, so wouldn't shock me if I get stopped out of this resistance gap. But I got it so perfectly on Thursday. Uppercut and fail of the resistance gap. The risk reward was so tight, and I already got off a little bit of it. But if for some reason MSTR is not very strong on Monday, while Bitcoin has been strong, that is a sign that it's relatively weak. We're in a major downtrend. Look for Bitcoin to start to falter and then get short MSTR, or another day rallying back up into the declining 200 or 20-day EMA and a gap zone at 110. That's a secondary spot that I'd look for. ASTS, we had the UFO group rally last week. This was part of that group. We got back through the 200-day, got back through the 50-day on Tuesday, and then chopped a little bit. Still want to see like one more push higher above the highs of this range, maybe into 95, and then look to get short. Another spot to watch as a short is a loss of the 200-day moving average, but I'd like to see like people who shorted this on the loss of the 200-day really get squeezed before this falls apart again. Like the more shorts you get squeezed out before the move actually like truly begins to the downside, the better. So it's nice that we pushed back through the 200-day and that we chopped here. It's still relatively strong compared to some of the other UFO names. So I would like to see like another rally to clear out any people that got short right around $90. So rally up to 95 or whatever. And then a loss of VWAP up here towards the highs could be shortable. Carvana, I am short this from the 9th. It's been just incredibly choppy. But because I got it perfectly against the resistance gap and the 200-day moving average, it's never come like back to my cost basis. So while it's annoying that it's not just like falling apart, it hasn't put any pressure on the position. On Wednesday, we rallied up into that resistance gap in the 50-day moving average. Some good relative strength on Thursday. So I would expect, like with XRT, nice looking base, if money continues to rotate, I would expect this to rally up to the 50-day and this resistance gap at $71. An uppercut and fail there could be a short. And then just keep your risks nice and tight, 2 to 3%. But Carvana, we all know this story. It rallied from, well, this is split adjusted now. So $1 up to 96. So almost 100x in 3 years after falling from those highs. And now just gone sideways for multiple months. You're under a declining 200-day moving average. This kind of looks like a stage 3 top to me. So I do want to ride the waterfall down and could add to the spot with an uppercut and fail, that 50-day and resistance gap. Last two metal and mining names. HYMC, this has been on the short watch list for a long time. Already had its kind of blow off move. Your big basing phase and then lower highs starting to break down here. Uppercut and fail, that resistance gap on Thursday could have been a short spot. Silver and gold rallied on Friday. Those markets were open. So we'll see if this does rally to start the week. We got a gap zone just under the 200-day moving average at $26. That's the spot that I'd be looking for. But it depends where we open on Monday. If things open up just like slightly higher, then that same resistance gap at $25 could be a spot to short. Then UAMY, you had the parabolic blow off top. I tried to trade this through here as we were building out these higher lows. I thought they kind of looked like the quantum names that finally got going and then squeezed another 100, 200%. But since then, like this was just kind of like a false higher high. Then we're putting in these higher lows, and I have not had a great read on rare earths. So if you're gonna fade me on any pick, like fade this one. But we've seen some lower highs now. We're rejecting that resistance gap on Thursday. Little uppercut and fail there at 780 is a spot that I'd look to get short, but not high on my priority list. That's gonna be the weekly prep video for the week of July 6th to the 10th. If you guys enjoyed it, please leave a like and subscribe to the channel. And if you want my market takes throughout the trading day, along with the live stream at the open and any trades that I personally take, you can sign up for the Market Pulse Discord using the link in the comment section. I hope you had a great long 4th of July weekend, and I'll see you guys on Monday's recap. Take care.